Tony, your note this morning says this looks to be a doozy. How much? How do we even begin to think about quantifying what this black swan event means for the equity market?
Well, you really can't. You have to assume at this point that you're getting this based on all the emergency conditions being tested in corporate America and all the cancellations of travel for conferences and other things. There's definitely going to be an economic kind of shock value that comes into play here that's going to create an environment where this volatility should continue. But, you know, to answer your question directly, it looks like the market's going to open up right toward the low of last Friday, which if you actually think about it, in other words, you were flat from a week ago, even though we've had the kind of volatility we've had. So honestly, you haven't seen, this is stuff that you see when you get these human nature kind of crash-like declines. And my friend Walter Deemer actually pointed out that after the European debt crisis initial swoon in 2011, Oliver, think about this. In 2011, the market went down 18% very, very quickly. And then you went through two and a half months of violent moves almost every day. So while this feels historically unique, it isn't.
Okay. Tony, off the highs, the speed that the NASDAQ dropped, that did set some records. But to your point, the overall magnitude, it's not unprecedented, right? What is it that is instilling this degree of fear selling? Is it just the count that's climbing in the U.S.? Do we just need to approach this from an inverse relationship, corona count to stocks? Is that the way it's going to be right now?
Well, it's really the corporate reaction and business reaction to the count. It's not that the biological side is so much dramatically worse. It's the fear that it gets worse has created a lot of cancellations of travel and otherwise non-essential business activity, and that is just unquantifiable. And the problem with something like this is you can't do it with a tick. It's not like a bank is failing, okay, let's save the bank. This is something that you can't quantify because if more cases show up, you got up to a 2-week incubation period, it's estimated by the experts, which means you can't really get an idea for 2 weeks. So you have this non-quantifiable business effect that is coming from a market. We downgraded on January 20th our market view because you had just had this euphoria where these kind of cultish stocks had gone parabolic, and nobody could, at that point, we were taking grief because nobody could see a reason that the market could go down. That was the time to be cautious. The time to be cautious isn't into a historic market swoon where, you know, you can't imagine a reason to get in.
Well, this is not just a pullback from the Teslas of the world, though, Tony. I mean, the virus is something separate. So the call that you had, do you adapt it? How do you then take this information and think about direction from here? Because if it just was a market in need of a correction, then I would imagine that you like the pullback then. I mean, do you want to dip into the water here?
Well, our view has been very clear. We have, which you can find on the Dwyer strategy website, and I know that you're aware of, and we've also put it on Twitter. When you get a human nature event that cracks the market, which is very similar to what's happening here, you get at some point in a severely oversold condition that warrants a reflex rally. That happened last Friday. Last Friday, you got this 12% drop, and all of a sudden everybody kind of looked around and said, all right, that's too far, too fast on the downside. And then you got those 2 days this week of more than 1,000 Dow point gain and almost 5% for both days. So that was your reflex rally, and now you're in the process of figuring out if that was a real low because the economic and perceived economic data and corporate comments get weak. So that's the negative side, right? So you can't imagine exactly where to buy it. It's not possible. Here's the offset to this. The fiscal and monetary stimulus that's going to come as a result of this is going to be extraordinary. I talked to my mortgage guy yesterday. He told me even with the credit that I have, and I've done so many mortgages with him, I'd have a 60-day wait because of the backlog. I asked him, is there any shutdown in money availability? And he said, no, not at this point. So the stimulus and the Fed cutting rates and interest rates going lower, no, it's not going to put somebody on a plane or in a vacation spot because of the coronavirus. What it does do is create an enormous amount of money so that you have, as bad as the drop could be from the coronavirus in economic activity, the other side of the V, Oliver, should be extraordinary with a global coordinated fiscal and monetary stimulus. They're going to throw everything at it.
Oh, yeah.
So you either make a bet that the whole world is literally going to zero in World War Z, or the recovery side of this is going to be extraordinary. So at this point, down 12%, into a swoon, into an extreme oversold condition, I think, even though you're going to be early, right? And we haven't, just for clarity, we have not gone back on offense yet. We have not upgraded our view. We are, I've said publicly, we are very close to it, depending on what today looks like. So at this point, and rather than looking at the risk, because that's clear, we're looking at the potential response in the markets as the stimulus comes.
Two questions here, Tony, that I want to make sure we get through. The first one is about the nature of the recovery. There's an explanation right now that people describe this. The coronavirus is not necessarily the cause, but the transmission mechanism for a market that was overdue after a decade to finally drop. That there was too much complacency, that companies have been frivolous in what they do with buybacks and cash, that this is going to be a straw that breaks a back, that causes companies to revisit what they do, for leverage in areas of the market to get slammed, for indebted companies to run out of cash flow. Do you buy into that? What kind of probability do we have to assign to that as a possible event happening?
It depends on how long this business impact from the coronavirus lasts. But yeah, I mean, you started out. It was in a market that was set up to get hit. If it wasn't coronavirus, it could have been Bernie Sanders. It could have been something else. This happens to be really non-quantifiable. But I remember all through January, people kept saying, "Oh, it's due for a correction. I can't wait to buy the correction." Corrections are only seen as natural, normal, and healthy until you actually get one. Right now we're in the midst of one, so what do you do with it? By definition, every major correction has to come with a perception of fundamental deterioration, or nobody would sell it.
Tony, when we're looking right now at an earnings that's still, according to Bloomberg, is at $177 for the year, do we have any idea how much that needs to come in? Because I'm looking at some of these chip makers. You would think that they're getting slammed by the China shutdown, and they're not even cutting that much for their guidance. Are they being unreasonable? Is this earnings expectation going to fall off a cliff, or is there a possibility that China's stability can help insulate whatever U.S. shutdown is coming?
I certainly think I've been below the street at 172 for a while. I think the street's going to come down and go below me. I think it is going to. My number's probably going to have to come down. But anybody that answers that question is lying to you. You don't know what this is. Just starting to roll through Europe. It's coming into the U.S. China's on the other side of that trade, but those are two pretty big areas that are just in the beginning of the economic retrenchment. So it's really hard to say. What I look for in times like this isn't trying to figure out what the right earnings number is going to be. We have a one-year T-bill at a point, last I looked, it was at a 0.33, 0.33. All right? That is not in the 10-year. That's at a 0.69. You're hard-pressed to tell me that you shouldn't have a higher valuation with that, knowing about the monetary and fiscal stimulus that's about to come at you.
Tony, to that point, here's the other one. I know people think I'm nuts to consider this, but I'm going with your explanation here as well, which is that you don't want to underestimate the force of the stimulus that's happening. If the recovery is something between a U or a V, I know a lot of people doubt that, but let's just do a hypothetical here. Are we going to have issues, though, when this employment report this morning is a monster? CPI and PPI have been climbing, and the Fed is juicing this thing up even more. If there's a U or V, are we looking at equity bubble and a Fed having to chase with hikes?
I don't think so. I think you're going to have a V. I think you're going to have a V, and the Fed is going to be more worried about a global shutdown than they're going to be worried, and also a markets collapse, then they're going to be worried about, a past, the data. You're getting a little bit of inflation from a restriction of goods and services because of what happened in China. So you're getting a little bit of a bump of inflation, but that's not because of demand-led inflation. That's more supply. So I don't believe that the Fed is going to worry as much about that or a strong payroll today, because that's pre-corona.
Right.
So I think they're going to be more worried about trying to protect the system and liquidity in it.
So on the other side of this, what point do you say, you know what, I want to buy stocks, and then what kind do you, Tony? Do you buy the stuff that's been expensive, the growth companies that like the lower rates, or do you buy the stuff that'll bounce back with the cyclical recovery, the banks, the industrials?
Yeah, you go. So Oliver, as I've said publicly, I've said here on the show, we are very close to moving to offense. And we've also publicly said when you move to offense, you want to do the post-recession trade, which means cyclical.
Okay.
Right? If you believe that the Fed and the global Fed and monetary and fiscal stimulus is going to be significant, and that you're going to get a recovery in the economy once the fear and business impact of COVID-19 passes, you're going to want to be in the most cyclical areas, because that response, growth, and market rally is going to be, I believe, historic.